Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and that's the last leg of the show where there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have Pankaj Matpal, MD, Optima Money Managers. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Let's take the first question, which is from Deeksha. And good evening, Pankaj. Welcome to the show. We have Deeksha's query via email, and she says she's investing 5,000 per month in mutual funds, HDFC Mid Cap, SBI Small Cap, HDFC Flexi Cap, and she wants to add SBI Contra and Nippon India Small Cap Fund going forward. And she's 23 years old and willing to invest for 10 to 15 years or even more. And she's also willing to step up her SIP as and when her income increases. Now, she wants to make a good portfolio for long term. So, Deeksha, first of all, congratulations. You are just 23 years old. You've understood the importance of having a long term portfolio. The kind of funds also you've picked up are pretty equity oriented, which also match up your investment time horizon. But then, are these funds good for you? Can you go more aggressive, or maybe you should just down? Let's understand all of this. Pankaj, how do you look at these existing funds? And because she's just starting her investment, you might also want to guide her in terms of aligning her financial goals, which she might have going forward in her life.
Kavita, good evening. I agree with you. See, she has allocation across market cap. She has allocation large cap through flexi cap fund. She has allocation in mid cap and small cap as well. As she has asked about Contra Fund. So SBI Contra Fund is a value oriented fund. So it will give some further diversification as far as style is concerned. So she should consider this fund in her portfolio. But small cap, I'll say once she has already one small cap fund in her portfolio, she doesn't need to add one more. So she can skip. She's asked about Nippon India small cap fund. The fund is good, but because she already has one small cap, so I don't think that she should add one more. SBI Contra will be good. And as you mentioned earlier about the goal, see, she has mentioned about the funds and allocation is good, but goals are not mentioned here. So what I suggest that any investor, for that matter, when you start investing, first you should decide your goals. Once you know your goals, you know that how much time you have to achieve those goals. Based on that, you can decide that which kind of schemes will be good for you. But here, considering the diversification, I'd say that you should stick to this investment portfolio and add this contra fund as well. But you skip this small cap.
All right. So also a lot of investors are interested in the Contra Fund, especially SBI Contra is leading this category as well, Pankaj. You might want to elaborate on this and maybe help Disha and other investors in analyzing whether this kind of category fits in their portfolio or not.
See, when we talk about value-oriented fund, these are well-diversified funds, can invest across the market cap. But as there are different styles of investment, one is a growth style, other style may be growth at reasonable price, or you can say one is value style. So all these different styles have their importance in the portfolio. And why this fund is in the portfolio of many investors, because in previous few years, we have seen that growth style, value style performed better than growth style. And that is the reason, because investors mostly, they look at the past returns, and based on that, they invest. So it does not mean that the Contra Fund, because it has performed very well in the past few years, and the same kind of returns you should expect. But for a long term, when you want to diversify your portfolio, there's the importance for every style. Considering that fact, you can consider whether ICICI Prudential Value Discovery or SBI Contra Fund or any other good performing value fund, but do not expect the similar return what you got in last few years.
All right, let's move on. Let's move on to our next question, Ranjan's question. Ranjan says that his current investment is 30 lakhs and he's doing SIP of 32,000 monthly. He's a government employee and he has retirement, he has NPS as far as retirement product is concerned. In SIP investment is going on in Parag Parekh, Flexi Cap, Kotak Mahindra Equity Opportunities and SBI Small Cap, Mid Asset Tax Saver, and he's also invested in ABSL Tax Relief Fund and UTI Nifty Index also, and he stopped SIP in these two funds, and large cap allocation is almost 50% in his portfolio. He wants to understand if he can exit the two funds where he stopped his SIP and how can he achieve his target.
See, first thing is about ELSS, because there is a lock-in of 3 years and all the units should complete. Means if you are investing through SIP, so it does not mean that when you started from that day, you should complete 3 years, but the units, because when you invest through SIP, so units will be allotted at different time. So the units which complete 3 years, then you can redeem those units. So if suppose you invested for 3 years and you want to redeem all the units together, you will have to wait 3 more years from the end of the date when you invested last time in SIP. So Mr. Ranjan needs to check that whether his units are in lock-in or these are free to be redeemed. So otherwise, he can definitely redeem those units and reinvest in some other funds. As far as UTI Nifty 50 index fund is concerned, it's a large cap fund. So though as he mentioned that he has a good allocation in large cap, so from that point of view, if you want to redeem, you can think about it. You can consider it. Otherwise, it's a good fund. In long term, we always expect that large cap index fund will give you stable and good returns. So, but there's no lock-in in that. You can redeem anytime if you want and switch to other funds of any category which you feel that will be suitable for you. And as you have allocation across this thing, large cap, mid cap, small cap, I think it's a good portfolio. And as you are investing in NPS, at the time of retirement, you will also get a choice to withdraw 60% of the pension fund as a lump sum, and rest 40% has to be utilized for buying annuity. So that time you can decide that how much pension you want and how much you want to redeem. But you have good corpus, and I expect in 25 years, if you invest, even in excluding NPS, you can accumulate around 10 crore rupees with your 30 lakh lump sum what you have now, and with your SIP of 25,000 rupees per month, you can expect around 10 crore rupees at 12% CAGR. So all the best to you.
We move on. Let's take Ayush Garg's question, Pankaj. He wants to invest 5 lakhs for 9 months with maximum downside tolerance of 15%. And he wants to understand the best investment category.
Kavita, see, for 9 months, it's not advisable to invest in equity funds, but because he has clearly mentioned that up to 15% downside risk he can tolerate, so it means he's expecting little higher returns. So for 9 months, I'll say that Ayush can consider conservative hybrid funds. Conservative hybrid funds means these funds can invest in equity and debt, and equity allocation can be somewhere 10% to 25% of the total asset of the scheme. And at the same time, these equity savings fund is another category which invest in equity shares, some small portion in debt, and there can be arbitrage basically. So it's arbitrage and debt combination majorly. So these two categories I can suggest. So in equity savings fund, he can consider Kotak Equity Savings Fund or ICICI Prudential Equity Savings Fund. And in conservative hybrid fund, Ayush can consider like HDFC Hybrid Debt Fund or SBI Conservative Hybrid Fund.
All right, next question from Delhi, Gautam Yadav, and he wants to know the tax implications of multi-asset mutual fund, and do all funds have the same tax implication, or does it depend upon the equity percentage of the portfolio of the fund? Very interesting question, Pankaj.
Yeah, and it's very important because now there is a lot of confusion. There are 3 categories actually for tax calculation, and it depends on how much equity allocation is there. As far as this multi-asset allocation category is concerned, because as per SEBI mandate, there has to be a minimum 3 asset classes, and each asset class, there will be allocation of minimum 10% of the total AUM of the scheme. Now it is up to the fund house how they want to manage. In some schemes, we see the minimum equity allocation is 65%, and there are some funds where equity allocation is less than 65%, but 35% or more than that. So, and I don't think there is any scheme which has less than 35%, but at least two types of calculation you will have to understand. So if the equity allocation is 65% or more, then it qualifies for equity taxation, where the holding period of 1 year is more than 1 year is long term, up to 1 is short term. Short term capital gain is 15%, and long term capital gain tax on such schemes will be at 10% on the amount exceeding 1 lakh rupees in one financial year. But where the equity allocation is 35% or more, but less than 65%, here holding period up to 3 years is short term, more than 3 years will be long term, and in long term, you will get indexation benefit. So the schemes which have allocation minimum 35%, I think this is a very good allocation now, because post-tax returns can be attractive in this case. So as the question is that there are different tax implications based on the equity allocation.
I think that's all the time we have for our viewer queries today. Pankaj, thank you so much for taking our time and helping our viewers with their mutual fund portfolio queries. On that note, time to sign off, but I'm going to leave you with our WhatsApp number and email ID to keep sending us your questions. Thank you so much for watching. Goodbye.